Right, so today we are going to look at a question from risk management. So when you look at risk management, you find that you are dealing with the both interest rate, but also foreign exchange. And this is one of those questions that does not miss in the exam. Either it comes in section A or it comes in section B, but it does not miss. So you have to be able to answer it, because it can even come in both sections where you have to do some exchange rate calculation in one of the sections, and then a full number, or maybe foreign exchange futures and forwards. So this question is called Fondir. Then, of course, when you got the requirements, it's a 50-mark question. And what they're asking you to do is to first of all explain the exposure Fondir faces with respect to the falling sales revenue from Italy. Suggest how this exposure could be managed. So then also prepare a report to the board, calculate what is received from Lothi in 4 months' time in dollars, and you're using the over-the-counter OTC forward rate and then the option itself. Then also you calculate the interest return in dollars for the cash flow from Lothi when the future contracts are used to hedge the interest rate fluctuations of 0.5%. So they want you to calculate an input number of future contracts needed and the gain or loss in the future market. And then comment on the results that you obtain from part 1 and 2, and address the queries raised by the board regarding alternative methods to hedge the receipt and the margin requirements. And then, of course, discuss if it would be beneficial for Fondir to manage its financial risks, and whether or not the company should communicate the risk management approach to the stakeholders. And all in all, you have marks for communication, analysis and evaluation, skepticism, and commercial acumen. Like the usual section A marks that they are giving you for free. That is, as long as you follow and do what is supposed to be done regarding the preparation of the report and how you arrange it, everything. So, and I'm sure that we have seen some of these. This should be something that by now you know how to set up. So when you go to this question itself, we have 3 exhibits, and they are saying the first exhibit looks at risk management of Fondir, which looks at details on communication. So Fondir is based in the USA, where they use dollars, and it is dealing in production and sales of high quality food under its popular brand called the Berry. Initially, the products were mainly aimed at the USA market, but increasingly the products are sold internationally to North and South America and Europe. So the rapid growth has meant that Fondir is expanding its production facilities and receiving its revenues in a variety of currencies. Developed a robust system to manage the operational risks, but so far it has not yet managed financial risks from currency and interest rate fluctuations. This is what we are looking at for this question. The board, on a whole, is supportive of the opinion that the company's financial risks should be managed using derivatives, and the company's approach to risk management should be communicated to the main stakeholder groups, including shareholders, managers, lenders, and employees. The marketing director questioned whether these and other financial risks should be managed at all. So this one doesn't see whether we should, and is actually saying that the cost of managing such risks would outweigh the benefits derived from the management of the risks, and therefore would be disadvantageous to the company. The finance director, on the other hand, argued that although many risks can be managed using derivatives, some risks were harder to manage. She gave an Italian market as an example, where the direct competitors from France and Germany have successfully penetrated the Italian market. As a result, Fondir has found its sales revenue from the Italian market falling, and the FD suggests that this is due to the weakening of the euro against the dollar. So there's a question about this. So make sure that as you're reading, at least you start to figure out what the question is asking for. The finance director is of the opinion that this relative weakening of the euro is likely to continue for some time and cannot be managed through the use of derivative instruments. So that is something that you need to deal with. Exhibit 2 looks at the receipt from Lothir. So Fondir sells products to companies and customers based in Lothir, country based in Europe, whose currency is the Lothir lira. They're expecting receipt of Lothir lira 57 million in 4 months' time on 1st May. Although there are no exchange-traded derivative products available for hedging Lothir lira, Fondir has access to 2 over-the-counter derivative products. So these are the ones that tell us to calculate. The first one is a 4-month forward rate agreed today based on the Lothir annual base rate of 6% plus 60 basis points, and the USA annual base rate of 3.3% plus 30 basis points. So the spot exchange rate between Lothir and the USA is 84 for $1. This is the first forward rate agreement. Second one is an over-the-counter call or put option with an exercise price of 84 Lothir lira. The premium for the option is 4 lira per dollar, and for the put option, it is 3 lira per dollar. The option premium is payable at the commencement of the option contract, and Fondir would borrow the money needed for the premium using its overdraft facility. Company pays interest on the overdraft at an annual rate of 5.4%. So we have the forward, then we have also the option. Okay, so then the board wants to know how the currency exposure to this receipt can be managed using the 2 instruments above, or whether there are alternative methods that we can use. So that's something we shall look at. Then the third exhibit talks about the short-term investment, which choose to the more financially beneficial hedging instrument to hedge the cash receipt from Lothir. Once the cash has been received in 4 months' time on 1st May, in exchange to dollars, it will be invested for a further 5 months before the cash is needed elsewhere. Fondir board wants to know how interest rate futures can be used to hedge against the increase or decrease 0.5 in the base rate. Fondir can invest funds on a short-term basis at the USA base rate, which is right now 3.3%, less 30 basis points. This is what they have given us about those futures. The 3 months dollar futures contracts have a contract size of 500,000. The June futures contract price is 96, quoted in terms of basis points minus 100, which is 100 minus annual yield. This is how they normally quote the futures price. Okay, they didn't have to say this part. In the calculations, the following can be assumed. Settlement of the future contracts is at the end of the month. Basis diminishes to 0 as at contract maturity based on monthly time intervals. There is no basis risk, and margin requirements can be ignored. The board has had the dealing with futures can be expensive because of margin requirements. So they want to know what margins are and whether or not dealing with futures is expensive because of that. So, I mean, quite a lot of information, especially if you have not done a question on risk management before. But that's why we are doing this question and other questions that are already on the platform, so that when you find yourself dealing with this question now, you know exactly how everything should actually be arranged in this way. So as we saw, the first part of this question is sort of like trying to explain the exposure for new with respect to the falling sales revenue from Italy and suggest how this exposure could be managed. So now, sales revenue from Italy are falling. So there is, and they told us the reason why that's the case. The FB said it's because of weakening euro against the dollar. So perhaps one thing you should first understand is that we are in the US. Okay, Fondir is in the US. And they use the dollar. So now, when we are in Italy and they use the euro, so when they use the euro, let's say if the euro is weakening, against the dollar. So what does that mean? It means that remember we are talking about revenue coming from Europe. So if the dollar is stronger than the euro, it means that when we sell things in Italy, they become more expensive. So when they become more expensive, then we get less revenues from them. Okay, because of the fact that the foreign exchange currency is actually causing our items to be more expensive than the people that can actually sell from within Italy, or people who use the euro, because the euro is a currency that maybe some of the countries that are dealing with in Italy with the other European countries are using, and therefore for them their goods stay cheaper, whereas the goods of Fondio become more expensive. That's why the revenues are falling. Okay, so now, so because of that, so that is one of the first things that you need to explain, because they are telling you to explain the exposure Fondio faces. So we can say Fondio's revenue may be falling because of the strengthening of the dollar with respect to the euro. So what does that mean? It means that since we are manufacturing from the US, so when the dollar strengthens, so this makes Fondio's goods more expensive in Italy compared to others whose currency is the euro. Okay, so that is that's the first thing that you need to explain. So that's the exposure that they have. Now, so now this can be short term, okay, if the currency stabilizes, or long term if the dollar continues to strengthen respect to the euro. In other words, the euro becomes sort of like inflated in a way. So now, when it comes to this, then you have to say whether, okay, if for a short term exposure, derivatives can be used. Okay, like forward rates, futures, and options. Okay, So to hedge the exposure, okay, that is when it is short term. Okay, when it's short term, you can deal with it like that. But however, when it is long term, it may not be able to actually be dealt with using derivatives. So now, if the exposure is long term, what do you do? So you may, for long term, Fondir needs to look at other strategies like pulling out of the Italian market, because the euro keeps on getting weaker and weaker, so you may not really need to stay in such a market. So you may need to pull out of it. So now, what other thing they can do? They could also set up a subsidiary in Italy such that they deal exclusively in euros and therefore can compete favorably. So that's what they can do. As I said, that is for long term. So this is what they wanted you to write for that first part. So now the second part, of course, is the one of the report. So the report, as we said, you have to say a report to the board of directors. Then you say this report calculates the amount of dollar receivable from the 4 months' time using the two options available, looks at how the interest rate or how the future receipt would be maybe invested based on the futures contracts options. Basically, summarize this one. Looks at the also whether it's beneficial to manage financial risks, and then you give a summary, okay, of these 4 requirements, and then you start writing. What you need to realize is that part 1 and 2 are both calculations, but you have to mention that the amount receivable in this is this one as per exhibit 1. Then you go to the Excel and put exhibit 1 and calculate that amount. So that's what we are going to do. So exhibit 1. Let's not use exhibits because these ones are exhibits. Let's use appendix. Appendix 1. So appendix 1, we are going to calculate the amount that is going to be received using over-the-counter forward rate and also the option itself. So now for the forward rate, we just need to determine, because you see, we are going to receive. So let's first do over-the-counter forward rate. So we are going to receive we are receiving $57 million in 3 months. Okay. Now, so we need to determine what rate to use. So with the over-the-counter forward rate, basically they are going to just give you a rate that you use in future. But here they have not kind of given it us. They are giving us the annual base rate of 6% plus 60 basis points in Lothier, and then the USA, and then they are saying that the spot right now is 84. So they have given us the spot 84. Remember, they have given it us in lira per dollar, which means that the dollar is the base currency. So now, for us to determine the 4 months, we shall use this one, and then we also kind of use the sort of like the inflation in the US and the inflation in Lothian. So we are going to use these rates that they are saying we are using. So 6 plus 60 basis points, and then also 3.3 plus 30 minus 30 basis points. So what we are going to see is, let me just open the formula sheet. So this is basically what we are using as the we have two things. We have the purchasing power parity and we have the interest rate parity. Now, because we have been given interests, we are going to use this one, interest rate parity. So this is what we need. So the over-the-counter future or the over-the-counter forward is going to be the spot which is 84 multiplied by 1 plus the interest rate in the counter currency. And what you need to know is that since they are telling us per dollar, that means that the AOL is the counter currency. And the interest rate there was 6% plus 60 basis points. So, which becomes 6.6. So 6.6% divided by 1 plus, this one is 3.3 minus 30 basis points, which is just 3%. So that should give you the OTC, which is about 86.9. But what I need to let you know is that, because remember we are receiving, need to know when we are receiving our money. In 4 months time. So they are giving us here the 4 months. Okay. So now the thing is, this is used to determine the amount in 1 year's time. So because this is 4 months, so that is just the a third of a year. Okay. So you have to divide this rate here. This rate of 6.6% by 3, also the 3.3% by 3. So that gives us 84.998. That's the over-the-counter forward rate. And now we can easily calculate the receipt. Now, this rate here is in LL per dollar, and we want to convert to dollars, so we are going to divide. When you are converting to the base currency, you divide. So we are dividing 357 million by this. So which gives us 4.2. These are $1 million. So this is the first, this is when we are looking at the forward rate. Now the second one is when we are looking at the option. Now for the option, they're saying we are either doing a put or a call option. So you need to understand what you need to do when it comes to for these options. Now, we need to convert to dollars. So we kind of have to buy dollars. So if we are going to buy dollars, then we are buying the base currency where they are quoting it. This is how they are quoting the options. They are quoting it for per dollar. So this is the base currency. So when you are going to buy the base currency, you actually what you get call options. So you get call options, and since you're getting call options, you need to, because they gave us here call options and put options. So the exercise price is here, 84. But when you are doing the call option, is $4 premium, or for 4 LL premium, and for the put is 3. So we are going to use the call option. So we are going to use the call option. After choosing the call option, then you kind of calculate. You first of all need to know how many contracts, because remember each of these they are saying they have a contract size. Where is the contract size? Or where is the contract size? Okay, I don't see the contract size yet. Maybe here they didn't tell us the contract size. Options usually carry contract sizes. So now, when you exercise the option, what will be the income in dollars? Remember, they've told us that it is at 84. So basically, we get 357 million by 84. So you get 4.25 when you exercise. However, the thing is that for these options, since they're options, you normally attract a premium. So the premium, they've told us that it is 4. So it is 4. And this is per contract, per $1, right? And these are dollars, remember. So the premium will be 4 multiplied by this much. So it will be 17 million. This premium here is in LL. Now we can convert it to dollars. Now the premium is paid right away. They told us that the option premium is paid by the commencement of the option contract. So we shall use the spot. So, and the spot is still, I think they told us it's 84. Yeah, 84. So we just convert this to dollars by dividing by 84. So the premium becomes $202. $202,000. So now they told us that also the company is going to would borrow the money needed to pay the premium. So we are going to get some interest on this premium. So interest for the premium. So we are going to need to borrow So, and how much are we paying as interest? They told us we are paying 5.4%. But this is an annual rate, so shall convert it to a 3 months rate or a 4 months rate, because this is 4 months, so divide by 3, because these are just 3 quarters in a year. So you'd get this amount multiplied by 1 plus the interest rate, which is 5.4, but divide by 3. Okay, so how much interest? So that is 206. So this is the amount you are going to borrow, but this is basically this is not the interest borrowing. This is the amount with interest. Okay, so which means that at the end of the day, what is the net receipt? So you receive this 4.2, but you remove this amount 206, which includes the premium and also the interest itself. If you wanted to do it a different way, you would do basically just calculate the interest on its own. You just multiply this like that. Like that. Then the net receipt would be this minus the premium minus the interest. Okay? Because these two amounts still give you the same 206. So which gives us 3.9. That's our net receipt. Now, of course, we can summarize it here, because in the you could summarize it here. If we are using the forward rate, we receive 4.2. We are using the option, we receive 3.9, which means that you would choose the forward rate on a monetary basis, strictly monetary basis. Of course, we are going to see that there are other things that you consider. For example, the forward rate suffers what we call default risk, whereby in case somebody doesn't really exercise the option as you, I mean, by the time you go to the bank, you go there and they are not going to give you your money. And yet you are agreed with them that in 4 months' time I'll exchange at this rate. So that is also something that can happen with forward rates. Options are more expensive, but they give you the option to exercise. And then, so that means you pay premium. That's why there's a reduction, but then these ones give you an upside. In case things are actually good, you benefit more than this. So that's why they are a little bit more expensive. So we shall come to that discussion when it comes to the part which tells us to. So basically we have done this. Then we are going to do the receipt. Then we are going to comment on those two. So that's where we shall have that discussion coming in. And of course, now let's go to the second part where we look at the interest return in dollars of the cash flow from Lothir when future contracts are used to hedge the interest rate fluctuations. So now, so we can have here our appendix 2. Now for appendix 2, they told us that once the money is received, okay, once the money is received, to be invested for another 5 months before you need it elsewhere. So we are trying to hedge for an increase or decrease of 0.5. We can invest on a short-term basis at 3.3% less 30 basis points. And they are telling us here information about that. They are saying that the contract size is $500,000. June futures contract price is 96.1, quoted in terms of basis points. And they're saying that these are the options. So now, here we have two figures, okay? So which one will you use? As I said, since the forward rate gives us the highest amount, we are going to assume that we are going to have 4.2 million. Remember, these are dollars. These are dollars. So the receipt, we are going to take $4.2 million. That's what we are going to receive. Now, if we need to now hedge that. So now when we want to do that, they are telling us that they want to see if we can use interest rate futures to hedge. Now for the futures, we can buy now and sell later, or sell now and buy later. Now, so now the thing is, remember they are telling us that interest rates are falling, okay? They are falling, and here they just said we don't know whether they will increase or decrease by 0.5%. But remember, when you are receiving dollars, so you have this money, now you want to deposit it for 5 months. So what is your worry? Your worry is interest rates will fall. Now you need to understand that when you are investing, you want interest rates to increase. So your worry is that they will fall. But when you are borrowing, you want the interest rates to fall. So your worry is that they will increase. Now, if you are worried that the interest rates will fall, then what do you do? Because we have 3 months contracts of 500,000. So now, if your interest rates are going to fall, if that's what your worry is, then what you do is to say, okay, if they fall, what happens? If they fall, the futures price will increase. So, which means that it's better to buy now and sell later. So, we buy futures now and sell them later. And that's what we call going long, going in long. And this is language that they use in the capital markets, where when you want to go long, it means that you buy something now and hold this so that you sell it later on when the price increases. When you want to short the market, you sell something now when the price is still high and buy it back when the price falls. So since we are going to go long into this, that means that we are going to buy futures now and sell them later. But at what price? So first of all, we need to also know how many contracts we need to hedge this 4.2. So contracts. Now remember that the contract size is 500,000. So to get how many contracts you need, there is a method whereby you get the money that you want to hedge, divide by the contract size, 500,000, multiply by the period for which you want to invest, which in this case is 5 months, divide by 3. And the reason why I divide by 3 is usually these futures prices are quoted for 3 months. So they are usually 3 month futures. Okay, you see they are telling you 3 months futures, and they are giving them to you for March, June, September, and December. So that's why we divide by 3. So this gives you how many contracts? And in this case, there are 14 contracts without any okay, some small rounding, but basically 14 futures, 14 contracts. Because sometimes you can find that they are 14.1, 14.4, whereby you don't have a perfect hedge and you need to look at under over hedging. In the exam, that usually covers a few marks, so you can always ignore it if you are out for time and you want to go to other numbers and you don't have to struggle with every mark. So you can always just round off unless the examiner asks you for the amount of over or under hedge. So we need 14 contracts that has been established. And now after knowing the contracts, then we need to know we have to calculate basis and what we call unexpired basis. Now basis is basically the difference between the spot rate and the future price. Right now we can borrow at 3.3, so that's the spot rate, and then the future price is at 96.1. So basis is going to be, now remember this is 100 minus annual yield. So even here you have to do the same. So you do 100 minus 3.3%. Let's not do percent because we are doing basis. Then subtract 96.1. So the basis becomes 0.6. Now unexpired basis. So we are going to do this for 5 months. We're now receiving the money on 1st May, and this is June. Okay, so you're using June. So May, so we have May. Oh, actually, we are still not yet there in actually May, but that's when we shall receive it. So right now, we are, which date is it? All I know is that this is going to be in 4 months time on 1st May. So that means that we are in, is it January, February, March? No, we are in February, March, April. Let me see if they told us if we are in March. Because we are going to receive in 4 months time on 1st May. So let's see, March, April, February, March, April. We are in January, February, March, April. So we are in January. We are in January. So we are going to receive in 4 months time on 1st May. So it means that for us to reach the June, futures, those are 6 months. Okay, those are 6 months. And when we reach 1st of May, we shall be left with how many months to finish June? May and June, so 2 months. So unexpired basis is basically 2 months out of the 6 months multiplied by this basis. That gives us 0.2. Now, we have 2 options because they told us to calculate for when interest rates increase or decrease by 0.5. So if interest rates increase by 0.5%, so that means that they go from 3.3 to 3.8%. Okay, so now after that, what is going to happen? So now, because we are now at 3.8, so what is the investment return? Remember that investment return, they told us that we can get at base rate minus 30 basis points. So if it is at 3.8, it becomes 3.5. So it will be 3.5% multiplied by the 4.2 million, okay? And we are only investing it for 5 out of 12 months. So that is going to be 61,251. That's the investment return. Now, because the amount now is at 3.8, so now what is going to be is that, remember what is our spot or the futures price or the expected future. So that one, remember, since we already have the unexpired basis, so we can calculate it. So remember that we were told that at the moment it is at 96.1. So if we are to remove the unexpired basis, remember it is 0.2. Okay, so how do you calculate it? You get 100 minus 3.8, then you subtract 0.2. Okay, so I can put it here so that you can remember it. 100 minus 3.8 minus 0.2. So that is the expected futures price, 96. So which means that we, since we are buying it at 96.1, we are actually going to lose, because so we are going to say loss on futures. It's going to be 96.2. Now these amounts here, 96.2, are usually given to us as they are like percentages, right? So we are going to say 96.1 minus this 96. So these ones, we can divide them by 100 because these are percentages in a way. Okay, divide them by 100. Then we can multiply them by the contract size, 500,000. And they are, remember, for 3 months out of 12. And there are 14 contracts that we have bought. Okay, so that gives us the loss on the futures price. Therefore, you can get the net return. So we got this, but we lost this. So which gives us 59 as the net return. Now, if the interest rate decreases, we can just copy all of this. So if it decreases, so if it is 3.3 and you subtract 0.5, so becomes 2.8. So investment return, remember it was 3.5, but that is because we subtracted 0. So it was actually 2.8 minus 0.3. Okay, multiplied by the amount. Okay, multiplied by 5 of 12. So that is how much you will get, 43. Then, what about the expected futures? So remember, this was supposed to be minus now 2.8 minus the unexpired basis. So that becomes 97. So if we bought at 96.1, and now the price is 97, we are going to make a profit. So this is a profit. And the profit is going to be 97 minus 96.1. Of course, we divide by 100 because these are percentages, multiplied by the 500,000, multiplied by 3 over 12, multiplied by the contracts, which are 14. So if you want, you can be fixing such figures so that they don't move. However, you can just retrace them and correct that. So now, since this is a profit we are adding, so the net becomes 59,501.39. And it looks like for this, you get the same exact amount. So it means that for these futures, this is what you get. And so let's see. I think that is what they wanted us to calculate. And now the next part is just to comment on the results. Okay. And also discuss whether beneficial for us to manage risks and whether or not company should communicate the risks management approach to the stakeholders. Now, I wonder whether this is understood before we go to those theory parts and the discussion part.
Meaning whether it's a call or put, how do you know that you're supposed to use it's supposed to be a call or it's supposed to be a put?
Yes. Now, there is a way that I used to explain to people where you start from the futures. Okay, I don't know if you understood why we chose why we chose to go long in the futures. Did you understand that part?
No, you can elaborate more on that also. I need clarity on that because that's where the confusion actually starts from.
Okay, so now when you have there are scenarios, but I don't know, I think the explanation also is that you haven't watched the video concerning this, and when you watch it, it will be clear, but let me explain a little bit. When you're hedging interest rates, you have to ask yourself, am I borrowing or depositing? Because remember, when you are borrowing, your worry is interest rates would actually increase. Okay? Because remember, when you're borrowing, you are paying interest. So if interest rate increases, you are actually having problems. So your worry is that the interest rates will increase, which means that if that's the worry, now, and also we saw that the futures price is usually 100 minus the interest rate, which means that when interest rate increases, the future price decreases. Is that part clear? You see how they listed here that the June futures contract is 96, which is quoted in terms of the basis points at 100 minus the interest. So this is how they quote future prices. And when they quote future prices like this, it means that always these two are inversely related. If the interest rates increase, future prices decrease. Now, if you worry that the interest rate will fall, that means, okay, in this case, let's start with the first person borrowing. If you worry that interest rate will increase, it means that futures price would fall. And the best way to benefit from that is that if you know that interest rate will fall, I mean futures price will fall, better to sell now and buy them later when they are falling. So better to sell futures now and buy them later. And this is what they call going short. That's what happens when you go short. You sell something now and buy it later. So that means that for borrowers, we sell futures now and buy them later. Okay, so that is for borrowing. Now the opposite occurs for depositing. Because they are the worry that interest rate to actually decrease. And that means that better to buy futures now and sell them later, which is what we call going long. And therefore here, we buy futures now and sell them later. Now, this is the logic you need to understand. And once you understand this logic, then it becomes easier for the options. So for the options, when we are borrowing, since we sell now, we buy put options, because the put option is the option to sell. Okay, that is when we are borrowing, we buy put options, and when we are depositing, since we are buying now, we buy call options. Okay, those are the two. So therefore, we can have this as a summary that a borrower always sells futures now and buys them later, and the person depositing buys futures now and sells them later. Or for the options, the borrower always buys put options and the depositor always buys call options. Now, there is more explanation that you can get when you look at the video, but I hope that this summary makes it clear for you.
But it has been helpful.
Okay.
Okay, thank you.
You're welcome. So now we go to these parts where we are commenting. Okay. So we are going to comment on the results obtained under this. Okay, under 1 and 2. Remember, for 1, we already talked about the result, because a little bit, of course, we are going to talk about more. But we said, when you look at the computation, we saw that when we use the over-the-counter forward rate, we get more money than when you use the option. But we said that the forward rate suffers what we call default risk, whereby when you reach the date when you're supposed to exchange, you can go to the bank and the bank says we don't have money. Because it's over the counter, the contract, okay, I would say contract, but it's usually actually a forward rate agreement. Okay, it is never written as a forward rate contract. It's called a forward rate agreement because the bank can say they don't have money and they don't give you that money. So that is the problem. It means that even if you fix your rate, then you can reach that time and they don't give you the money because the maybe don't have it, or they feel they are going to make a loss and they jump out of the deal. So that's the problem. The option on the other hand is more expensive, but it gives you the upside, so you can always be able to get the benefit in case the interest rate actually start increasing. Now, of course, when you are choosing, you choose the one which gives you the highest amount, which is 4.2. So you choose the forward rate. You just mention these things. I'm going to take you to the solution for a better write-up of that, but what I want you to understand are those key points. Then, on the other hand, again, when we are deciding on whether we are looking at this future, we have found out that for this future, we are getting the same amount if the interest rates increase or when they actually decrease. And this is expected because the forward rate and the futures, they fix you on a given interest rate, such that even if the interest rate were to increase or decrease, that's what you will pay you as a person. And the problem with that is that if the interest rate actually, since we are depositing, remember, if the interest rate actually increased, we shall not benefit. As you can see here, we didn't benefit. But also, we shall not lose out if they decreased. So that's the thing about the forward, about the futures. However, it is assuming basis diminishes to zero as they reach maturity of the futures contract, which is not something that is very correct. Also, it has assumed that there is no margin call, which is something they told us in the exam in the question itself, and they are going to ask us to discuss it here. So then also now they want to discuss if we can manage the financial risk and whether or not the company should communicate its risk. So let's go to the solution and look at how this is written, and then also look at the benefits and whether we should communicate the approach to the stakeholders. Of course, the answer is yes, but we are going to just find out reasons as to why we should communicate. So let me just okay. So this is the question, and as you can see, the first part we answered was to do with the. First of all, remember I told you whenever you go to this, you also see what they have put here as the key answer tips. And here they are saying that this is a key syllabus area where we can calculate hedging methods such as forward, futures, options, etc. And these topics are usually short 25-mark questions, but we can also put it in a 15-mark question instead. Okay, so basically section A can also come with this question as it did in this case. And we answered this part, you read there when you get time as you go through. So just to go to the report part. So the report, as we said, shows the comments on how income from the sale can be hedged using currency and interest rate derivatives. Then it looks at the need for and communication of the risk management strategies. So then it starts calculating. So Appendix 1 shows that hedging receipt from Lothil using the over-the-counter gives 4.2 million, more beneficial than the 3.9 or 4.4. We have some rounding off. This is the fact that the cost of premium which is paid for options makes this figure lower. However, options present an opportunity for Fondir to abandon the contract should the exchange rates actually move in the company's favor. But with the forwards, that's not possible and the amount is fixed. I think I've said that already, and I just want to see whether they mention the thing about default risk. Appendix 2 shows that the futures hedge contracts that the interest earned from the invested funds is fixed at 59, whether the interest rate increases or decreases. Okay, so this means that the interest rate is certain. However, if the basis, the prediction is saying that basis diminishes in the straight line and that there is no basis risk. So this is not certain. So the income received may therefore vary little due to the uncertainty of the movement in basis. So I also mentioned this one. So now the question also had something about alternatives that can be chosen. So here we have things like money markets, okay, where you borrow today so that when you receive that money later it pays off. Then also you convert a spot rate and then use the funds for other purposes today. Or you can actually look at companies based in a discount rate for paying immediately, such that you don't have to have that risk. So you tell them, if you pay right now, you get maybe 1% discount. So here the risk will be reduced, but also you need to consider carefully which of the two. So this is the option that suggestion has been made for what else could be done instead of using those. Then the margin requirements are also discussed. So now I'm going to explain what margin requirements mean. Okay, before we read here. So what happens is that when you are using futures, you don't pay the money right away. Instead, you make a deposit, and then every day when the exchange rates move, they can move in your favor or against your favor. When they move in your favor, they credit your account with some money. But when they move against you, then they ask you to come and pay some margin requirement. So you pay some money. And that happens until at the end of the period of maturity, whereby now they balance out and they see what has to be paid to you or what you have to pay. So that's what they call depositing a margin. Okay, then the practice ensures that the risk and the impact of any default is minimized. So if we do not fulfill the contract obligation, the price move against it, the margin is used to pay for any shortfall. So it's like an insurance in a way. So the deposit could tie up company funds while the futures contracts are open, although these will be returned to the company when the contracts are closed. However, dealing in futures needs not be inexpensive as other forms of hedging, because other forms of hedging have other transaction fees, like when you are looking at options. So margins are usually lower compared to the value of the contract. Therefore, large amounts of exposure can be hedged with relatively small margin deposit. This question was asking us whether margins are going to make futures expensive, but here we are saying they are usually not very expensive. Okay. Then how do you manage financial risk? This was another part of the question. So the marketing director was saying that we don't have to hedge everything. Okay. So sometimes the cost can actually exceed the hedge that you are making or the risk that you are hedging because of the operational and transactional needs. So, however, it is beneficial as well. If the cost outweigh the benefit, then we need to think carefully about the need to engage in such activity. You don't always do anything if the cost outweighs the benefit. So you need to look at the potential benefits of risk management in more detail to assess whether or not the risk management can be beneficial. So now, how does it impact the value of Fondir? It can increase the future cash flows or reduce the cost of capital. So which means that you desire to reduce the risk of volatility of the cash flows, which may reduce the cost of capital, and therefore, if the cost of capital is lower, that means that you are able to invest in many different ventures, and also the shareholders' need also reduces. Now, so we need to assess the extent to which the cost of capital reduces and therefore lead to the increase in company's value. And then I think what is left is discussing whether or not we should communicate. Okay. There's another thing they are talking about here, whether it can increase cash flows. So That may be the case because when you reduce on how much you're paying, then you have more money. Okay. Now, you read this other part here just to see what else is being said there. But what we want to finish with is whether or not they should communicate the approach to the stakeholders. Okay, and they're saying that it's beneficial to the company stakeholders so that they know that the company is creating value for them in a stable and sustainable manner. So employees and managers need to understand the company's continued operation. So if the company is not dealing with risks very well, it may not last for the next 5 years. So it gives them comfort that the company will survive. And also, because the managers and employees are not diversified, then they feel the full impact of the risk exposure and therefore risk management. So therefore, it helps them to be more engaged with the company. Lenders will be willing to lend on favorable terms. Now, all these points don't have to be made in one big paragraph. Okay, you should always, because you can see here they are mixing things up, and it's better to always have a paragraph for each point you are making, so that the examiner can see how you're flowing. Okay. Also, assurance is given to the company stakeholders and corroborates their expectations, reduce agency costs, and then also attract appropriate shareholder clientele to invest in the company. So, but now, however, they are saying, however, do not give them so much information, because if you have everything out there, then the competition may know what your positions are, and then they may use it to reduce your competitive power. So you need to strike a balance between making those guys happy, but also not giving them anything at all. So then you conclude. Okay. In the conclusion, they show derivative instruments can be used to risk the currency. The content of the report comments on the results which show the highest receipt from the forward contract. The future contracts fix the interest return at 59. Also addresses the queries raised by the board. And then you finish. Now, I hope that you can see how the question has been flowing, because some people calculate and get all the marks right, but then they fail to flow the report part, and therefore lose out communication marks, analysis marks, and it becomes very difficult for you to pass the exam when you are skipping out on such marks. Is there any question from you at this point? Hello, Monica, do you have any questions for me?
How about I said none for now. I'll just, when I go through that question, if there are any questions, I'll get in touch.
Okay. All right.
Yes.
So I guess this is it for today. As I promised, I'm going to have a composition class tomorrow. That's if you are going to be available. If not, you can let me know so that we can I can just let you do your reading for tomorrow. If you be around, you can let me know, and then I prepare for it.
How about I'll be around? I'll make it a point. I've started watching the videos,
Mm,
so it will also help me. It will give me
okay.
guidance. So
All
it's
right.
okay
So
with
see you
that.
tomorrow. Mm,
Okay, fine. Thank you very much.
okay. Have a good night.
Good night.